Each year, the IRS makes inflation adjustments that affect how much income is taxed, how much you can deduct, and how much you can contribute to tax-advantaged accounts. Most of the time, these updates are incremental, but even small changes can matter if you're saving for retirement, managing taxable income, or planning around these contributions. In this video, I want to walk through what's changing in 2026 in two areas. First, federal income tax brackets and standard deduction, and second, the retirement plan contribution limits, including 401ks, IRAs, and a few other related accounts. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Let's start with federal income taxes. The IRS adjusts tax brackets and the standard deduction each year for inflation. The structure stays the same, but the thresholds do move around. In 2026, if you're single or married filing separately, the standard deduction is now $16,100. If you're married filing jointly, it's $32,200. And if you're head of household, it's $24,150. Now let's look at tax brackets. The top federal bracket is still 37%, but what changes is the income level where each rate applies. In 2026, the 37% bracket starts at taxable income above $640,600 for single filers and $768,700 for married couples filing jointly. The biggest change comes within the middle brackets. For single filers, the 24% bracket now extends to $201,775 of taxable income. For married filing jointly, it extends to $403,550. And the 22% bracket runs up to $105,700 for single filers and $211,400 for married couples. Those ranges matter because there were raises, bonuses, retirement income, and investment income tend to land for many households. And just to keep this grounded, tax brackets still work the same way they always have. Only the dollars that spill into the next bracket are taxed at a higher rate. What's changed in 2026 is simply where those layers start and end. When you first look at the updates, they don't seem terribly dramatic. The brackets move a bit, the deduction goes up a bit, and that's it. Where people actually notice the difference is how income layers together. If you have more than one source of taxable income, whether that's salary, bonuses, investment income, or retirement distributions, those bracket boundaries determine how much flexibility you have before your marginal rate changes. It also affects comparisons from one year to the next. You can earn roughly the same amount as last year and still end up with a slightly different tax result, simply because more of your income is being taxed in a different part of the bracket structure. Now let's shift to retirement accounts, where changes tend to be easier to see because it's generally a higher contribution limit change. For 2026, the employee contribution limit for 401k plans increased to $24,500. That same limit applies to 403b plans and the federal thrift savings plan. If you're in a 457b, the deferral limit also increases to $24,500. For individuals age 50 and older, the standard catch-up contribution increases to $8,000, and that brings the total possible 401k contribution to $32,500. There's also a higher catch-up category for people ages 60 through 63. For 2026, that limit remains $11,250 for applicable employer plans. This creates a short window where contribution capacity is meaningfully higher than it was before, assuming your plan supports it. There's also one detail in the retirement updates that's more technical but worth understanding. For 2026, the IRS sets the wage threshold for mandatory Roth catch-up treatment at $150,000. In certain employer plans, individuals above that wage level must make catch-up contributions on a Roth basis instead of pre-tax. That doesn't change contribution limits, but it just changes the tax treatment of dollars going into your retirement account. Whether or not and how this applies depends entirely on your employer's plan and payroll setup. IRA limits also increase in 2026. The base IRA contribution limit is now $7,500. For individuals age 50 and older, the catch-up contribution increases to $1,100, bringing the total to $8,600. Roth IRA eligibility continues to depend on income. For 2026, Roth IRA contributions begin to phase out at $153,000 of income for single filers and heads of household, and at $242,000 for married couples filing jointly. The phase-out ranges end at $168K and $252K respectively. Those higher income thresholds mean that some people who were close to the limit in prior years may find that they have more room in 2026. Income limits for deductible traditional IRA contributions also increased, though those depend on workplace plan coverage and filing status. One last update worth noting is around health savings accounts, or HSAs. For 2026, the HSA contribution limit increases to $4,400 for self-only coverage and $8,750 for family coverage. As with prior years, individuals age 55 or older can make an additional catch-up contribution. Overall, none of these updates fundamentally change how the tax system or retirement accounts work, but they do reset the thresholds that everything else is built around. Understanding where those boundaries sit in 2026 gives you a clear starting point for planning the year ahead. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you found this helpful, be sure to check out our other videos at www.pacwealth.com, as well as our YouTube page.